Welcome to my channel. Today we're diving deep into a topic that might sound complicated at first, but by the end, you'll not only understand it, you might even start seeing the world economy in a whole new light. Let me ask you, why has China, once obsessed with buying US debt, suddenly started selling it off? What future does China see that's making it change its entire economic strategy? And how could this quiet move, ignored by most headlines, send shockwaves through the global economy? Let's uncover the invisible gears of global finance and the rising tension between the world's biggest economies. Get ready, this one's big. For years, one strange habit has defined the global financial market. China buying massive amounts of US government debt. We're talking about Treasury bonds, those little pieces of paper that represent America borrowing money. At one point, China was the largest holder of these US IOUs, even more than America's closest allies. But look closer at the most recent charts, and something has changed. Japan now holds the top spot, with over $1.1 trillion in US debt. China? It's dropped behind, and it's been selling off since 2018. Back then, China was holding over $1.3 trillion in US debt. Now, just about $760 billion. That's nearly half. So what's going on? To understand this, we need to ask a more basic question. What exactly is US government debt? When the US government spends more than it earns, say on military, infrastructure, or international aid, it borrows money by issuing bonds. These bonds come in different types: short-term, mid-term, and long-term Treasury securities. Investors buy these, expecting the US will pay them back, with interest, years later. Before 1971, this borrowing was limited by the gold standard. Every dollar printed had to be backed by actual gold in the vault. Governments couldn't just print or borrow money freely. But then came the turning point. In 1971, President Nixon officially ended the gold standard. From that moment on, dollars weren't backed by gold, just by trust in the US government. This gave the US and many other countries a dangerous kind of freedom. They could print and borrow far more than before, as long as investors believed in them. Fast forward to today, and America's debt has skyrocketed, now sitting above $35 trillion. A piece of that, roughly $700 billion, is in China's hands. The rest? Held by Japan, other countries, pension funds, US banks, and local investors. So, why did China in the early 2000s start buying US debt like crazy? Because China's economy was booming. Factories were churning out goods for the world. Foreign investment was pouring in. China was exporting everything, from toys to tech, collecting billions in US dollars. Instead of letting those dollars sit idle, China reinvested them. And where better than the safest place on earth, US Treasury bonds? Low risk, easy to buy and sell, backed by the world's biggest economy. A smart move. At one point, China held more than $1.3 trillion in US debt. But then, things began to shift. Why? Several reasons. First, the Belt and Road Initiative. This is China's massive infrastructure project, connecting Asia, Africa, and Europe through roads, railways, ports, and pipelines. To fund it, China began redirecting its reserves, spending less on US debt and more on global projects. Second, BRICS, an economic alliance between Brazil, Russia, India, China, and South Africa. Their goal? Reduce dependence on Western financial systems like the IMF and World Bank. By cutting back on U.S. bonds, they're taking steps towards that independence. Third, gold. China's central bank has been quietly stacking gold reserves. Why? Because gold isn't tied to any one currency or political system. It's a way to protect their wealth in case things get messy. And that leads us to the biggest question. What does China see coming? If China is preparing for economic instability, if they're expecting rising tensions, sanctions, or a dollar crisis, then selling U.S. bonds and buying gold is a powerful defensive move. But here's where it gets even more interesting. If China suddenly dumps its U.S. bonds, the consequences could be massive. Less demand for treasuries means lower prices. And when bond prices drop, interest rates go up. That makes borrowing more expensive for the U.S. government. A serious problem for a country already swimming in debt. It could also shake the value of the dollar. And while a weaker dollar might help U.S. exports become cheaper, it would also make imports more expensive, hurting everyday Americans and potentially sparking inflation. On top of that, financial markets, used to viewing U.S. bonds as ultra-safe, might panic. Confidence could fall, volatility could rise, and the whole system could wobble. Now let's not overstate it. The U.S. Treasury market is enormous. Over $500 billion of trades happen every single day. So a sudden Chinese exit wouldn't crash the system overnight. But it could send tremors and raise serious questions about the future of global finance. So, what does all this mean? It means we're entering a new era. One where China is shifting from silent investor to cautious strategist. Where alliances are shifting and economic power is being rebalanced. And in the middle of it all stands the US dollar. Still king, but maybe not untouchable. But here's the part no one talks about. How this affects you. If global debt markets become unstable, or if major countries like China trigger financial tremors, regular people can feel the impact too. So here are a few smart steps you can take to protect yourself. Don't ignore your savings. Even small amounts saved consistently in stable environments, like high-interest savings accounts or diversified index funds, can make a difference during economic shifts. Avoid high-interest debt. Credit card debt, especially during rising interest rate cycles, can become a financial trap. Diversify your assets. Don't put everything into one currency, one country, or one investment type. Just like China is diversifying from U.S. bonds into gold, variety is protection. Stay informed. Global events have local consequences. Changes in China's economic behavior can affect everything from inflation to job markets. And finally, don't panic. The markets are big, and they've weathered many storms. What matters is being prepared, not scared. Now it's your turn. What do you think? Is China really preparing for an economic earthquake? Can it use its remaining U.S. bonds as leverage against America? And with global markets soaring in 2024, could 2025 be the year the bubble finally bursts? Share your thoughts in the comments. I read everyone. Until next time, stay curious, stay safe. And don't forget to subscribe.